In this segment, we are going to cover a summary of Level 1 equity. We'll start with market organization and structure. This is a very long reading and it's also extremely important. First, the functions of the financial system. This reading actually serves as an introduction not only to equity but also to fixed income and derivatives. The financial system includes markets and financial intermediaries that help transfer financial assets, real assets, and financial risk. From an exam perspective, it's important that you learn the 6 uses of the. From an exam perspective, you need to know the following. People use the financial system for 6 main purposes: to save money for the future, to borrow money for current use, to raise capital, this is especially in the context of companies, to manage risk, and we learn how derivatives are used to do this, to exchange assets for immediate and future deliveries, and to trade on information. In other words, with this last point, if you have information based on which you want to buy an asset, then markets allow you to do that. The financial system facilitates the following: the achievement of the purpose for which people use the financial system. So in other words, the system allows us to do these 6 things. The financial system facilitates the discovery of the rates of return that equate aggregate savings with aggregate borrowings. And finally, the financial system facilitates the allocation of capital to the best uses. This is also called allocational efficiency. A single transaction can achieve more than one purpose. Determining rates of return. The financial markets allow us to determine rates of return, and the bullet points here are quite testable. Saving, borrowing, and selling equity are means of moving money through time. Money can travel forward in time if an equal amount of money is traveling in the other direction. Savers will move more money from the present to the future if the expected return is high. Now, I've picked these statements because I think examiners might test this. This concept of moving money forward and back, and the fact that an equal amount needs to move forward and back, the idea is fairly straightforward. If you are lending, then somebody has to be borrowing. When you are borrowing, what are you doing? You are essentially doing the opposite of lending. So borrowing money means that you are using money today, and saving is where you are transferring money to the future. So the simple point here is that obviously the amount of lending has to be equal to the amount of borrowing. Equilibrium interest rate is the rate at which the aggregate supply of funds is equal to the aggregate demand for funds. And this final point is also important. Different equilibrium rates, we'll have different equilibrium rates for different securities based on their characteristics. Obviously, the equilibrium rate for risk-free securities is going to be different for the equilibrium rates for bonds that are rated BBB. And in any market, be it the market for BBB rated bonds or the market for stocks, the required rate of return or the equilibrium rate of return will be based on buyers and sellers agreeing on a certain rate. Capital allocation efficiency, and this term is important. Primary capital markets are the markets in which companies and governments raise capital. Economies are allocationally efficient when financial systems allocate funds to uses that are most productive. This slide represents a summary of assets and contracts and types of markets, and this is the basis of what we'll be studying in this segment, and then in fixed income, and then derivatives. Classifications of assets and markets. When we talk about different kinds of assets, we could be talking about securities. Securities includes fixed income securities, equities, and other pooled investments such as mutual funds. People also trade in currencies. When we say contracts, we are talking about derivatives, and that's shown over here. A contract is an agreement among traders to do something in the future. So you can have a forward contract or futures contracts or options. These are also called derivatives because they derive their value based on an underlying asset. These contracts can be cash delivery or they can be settled physically. This material is covered in detail in derivatives. We can also buy and sell commodities, and then we can buy and sell real assets. By real assets, we mean equipment, for example, or property. There are different types of markets, and you need to understand the distinctions here. Spot market versus forward markets. In the spot market, you are buying today. In the forward market, you are agreeing today to buy in the future. Primary markets versus secondary markets. In primary markets, the issuer of a security is raising money. In the secondary market, the securities are trading between investors. Money markets versus capital markets. Money markets are markets for debt securities with maturity of less than 1 year. Capital markets refers to longer term securities such as longer term bonds and stocks. Traditional investments versus alternative investment markets. Stocks and bonds are generally considered traditional. Alternative investments are commodities. You can also have hedge funds, private equity, and so on. Publicly traded securities are securities which are traded on an exchange. Private securities are not traded on an exchange. Financial intermediaries. Financial intermediaries help entities achieve their financial goals. They provide products and services which help connect buyers to sellers. There are several types of intermediaries: brokers, exchanges, and alternative trading systems. These are either electronic entities or people who connect buyers and sellers. So that's the job of a broker. A broker doesn't actually buy anything. A broker simply connects buyers and sellers. Dealers are also financial intermediaries. The fundamental difference between a dealer and a broker is that a dealer will buy the asset, have his own inventory, and then sell to the other party. Securitizers are entities that buy a pool of assets, such as mortgage securities, and then create securities based on that pool. And this is something that we see in fixed income. We also saw this briefly in FRA. Depository institutions and other financial corporations. Your classic depository institution is a bank which collects money from depositors and then lends that money to companies. Insurance companies, which are companies that take away risk but then obviously charge for it. Arbitragers are people or entities who try to exploit mispricing in the market. And then you have settlement and custodial services. Moving now to the sorts of positions that you can take in securities. The most basic position is a long position. Here you essentially buy a stock or buy some asset. So when you buy an asset, you say that you have a long position. When we talk about a short position in the context of a stock or a short sale, here is what this means. When you are going short on a stock, you borrow the stock from the long party, you sell the borrowed security to another trader, and then later you close your position by repurchasing that stock and returning it to the original entity. The point of doing this is making money when the market goes down. So if the stock is currently at 20 and you expect the market to go down, you will borrow the stock for 20 and sell it. And then let's say the market does go down to 15. Later you will buy the stock for 15 and then return the stock to the entity from whom you borrow. So this is a short position. A leveraged position is where you borrow money and use borrowed money to buy a stock. So a stock might be worth 100, and what you could do is put $40 of your own and borrow $60 to buy the stock. This would be called a leveraged position. In this situation, you might be asked to calculate the leverage ratio. The leverage ratio is the overall value of the stock divided by how much money you put in. So in this case, the leverage ratio is 100 over 40, which is 2.5. The leverage ratio magnifies your returns, and it also magnifies your losses. If you do a leveraged buy, so you borrow money to buy, when you borrow money, the loan that you take out, the money that you borrow is called a margin loan, and the interest rate that you pay is called the call money rate. If you buy based on leverage and the stock price starts coming down, at some level your broker will give you a call, and that call is called the margin call. You need to be able to calculate the price at which you will get a margin call. And let's do that through a simple example. Your broker allows you to purchase stocks on margin. The initial requirement is 40% and the maintenance margin requirement is 20%. You purchase a stock for 50 using 20 of your own money and borrow the rest. So this initial margin requirement of 40% means that you need to put in at least 40% of your money. If you want, you can put in more. And that's what you've done here. You've put in 40% of your money, so you've put in 20, and you have borrowed the rest, so you borrowed 30. The interest rate on borrowed money is 5%. That's just given. What is the leverage ratio here? The leverage ratio would be the price of the stock 50 divided by how much money you put in 20. So the leverage ratio is 2.5. Notice that this is the same as leverage that you discuss in financial reporting. In financial reporting, leverage is equal to asset over equity. In this case, the asset is the stock and equity is how much money you are putting in. So same term, essentially the same formula. So the next question is, at what price will you receive a margin call? And that is also shown over here. This is the formula that you need to remember. The margin call price is the original price at which you bought the stock, which is 50, into 1 minus the initial margin. Initial margin is 0.4. So this should actually be 0.4 over here, divided by 1 minus 0.25, where 0.25 is the maintenance margin. And that gives you 40. So if the stock price comes down to 40, you will receive a margin call. Another related question. You believe stock X will go down in price and decide to short sell 500 shares at the current price of 30. How does the 40% margin requirement impact you? So what is happening here now is, obviously the broker will be concerned about what happens if the stock goes up because you are short selling. The margin requirement will also have an impact over here. If the margin requirement is 40%, that means that you need to put in 0.4, which is 40%, into 500 into 30. That's the amount that you are short selling. So you actually need to deposit a margin of 6,000. Here is another concept that is relatively straightforward, but lots of people have issues with this, so I want to make sure that you understand what to do. What is the overall return given the following data? So you buy a stock for this amount, and finally, let's say 6 months later, you sell for 32. This is the number of shares you purchased. Leverage ratio is 2. What does that mean? So this means that your stock price 30 divided by the equity, the amount of money that you put in, is equal to 2. So how much money did you put in then? So you must have put in 15. The call money rate is 5%. This is the dividend. So to calculate the return, there are different ways of doing this, but I think the simplest method is the following. Figure out how much cost you incurred initially. You incurred, on a per stock basis, you spent 15. We calculated that based on the leverage ratio. And then you are told that the commission is 2 cents per share, which means that on a per share basis, you spend 15.02. For 500 shares, you did that number times 500. So you come up with this. Now, at the end of your holding period, you also calculate how much money you have. So you are told that the share price is 32, which means you will have 32.50 into 500, but you need to pay back the loan. So How much did you borrow on a per share basis? You borrowed 15. We've established that stock price was 30, you put in 15, so obviously you must have borrowed 15. So 15 per share, and where is this 1.05 coming from? The 5% interest. So we are actually assuming that the 5% is for your holding period. We should actually say that the holding period is 1 year then. So you subtract that. And then you also subtract the commission at the end, because you pay a commission when you buy and you also pay a commission when you sell. So you subtract the 2 cents into 500, and this is how much you have at the end. The return then is 8365 over 7510 minus 1, and that will give you 11.38%. Next we come to different kinds of orders. Buyers and sellers communicate with entities that arrange their trades by issuing orders. Most orders have additional instructions such as execution, validity, and clearing. The point is simple. If you want to buy or sell, you have to tell your broker that you want this many shares and you want to buy or you want to sell. But from a testability perspective, you need to understand these other concepts: execution instructions, validity, and clearing. The most important is the execution instructions. These indicate how to fill orders. So remember, execution instructions is a how-to. So how to fill the order. The most common instructions are market orders and limit orders. Market orders obtain the best price immediately when filling the order. These generally execute immediately but can be expensive, because you are telling your broker that, look, I want to buy no matter what. So if the price is shooting up, then you might end up buying at a high price, and that is what makes this expensive. Or if the price is dropping and you tell your broker to sell, it is possible that he will sell at a fairly low price, but the order will execute because you've told your broker that you need to execute this order at whatever market price might be in effect. With a limit order, you tell the broker the following: obtain the best price immediately available, but do not accept any price higher than the limit price when buying or lower than the limit price when selling. These are often executed at the limit price, but it is not necessary. So if a stock is currently at 50 and you put in a limit buy order, so what does that mean? You are telling your broker that I want to buy. Typically what you might also say that your limit is 51, that if the stock price starts going up, I want you to buy at the best possible price but never pay more than 51. So if the stock price shoots up above 51, then you might not buy it, the order will not execute. If you put in a limit at 51, is it possible that the order executes at 50.50? It's possible. So it is possible that the order executes at 50.50. All right. What you are looking at here is a limit order book which is showing bids and offers. So the point here is that bids refer to the prices at which dealers are willing to buy, and offers refers to the price at which dealers are willing to sell. So offer is sometimes also referred to as the ask price, in the sense that this is what dealers are asking for. So when we talk about the market is represented by the highest bid and the lowest offer. Because if you think about it, the bid refers to the price at which a dealer will buy. So which dealer will you go to? The dealer that is selling at a high price or a low price? Obviously, you will go to the dealer who is buying at a high price, because the dealer buying means you are selling. So you would want to sell at a high price. What about on the right where we have offers? This is how much the dealer will sell for, right? In other words, now on the right, the investor or you are buying. So when it comes to buying, then you would like to buy at the lowest possible price. So in this picture, The market is 45-48, where 45 stands for the bid, 48 stands for the offer. The spread or the difference between 48 and 45 is big in this made-up example. In the real world, the spread will obviously be much less, but this is just illustrating a point. So what is the market right now? The market is bid 45 and offer 48. Now, if another dealer comes in and puts in an offer that is at 47, then what do we say he's doing? He's creating a new market. Or if another dealer comes in and puts in a bid at 45.50, he's also creating a new market. Now, I've mentioned that 48 and 45 are the market. So anybody who goes and trades at 48 or 45 with an existing order out there is taking the market. Somebody who comes in and places and helps create a new market by putting in an offer of 47, we say that he is creating a new market. Somebody who has an offer at 52 is putting in an order that is far away from the market. Okay, so these are some basic terms that you need to know. In the regular lecture and the curriculum, there are more details, but these points are the most important ones. We've talked about execution instructions. Now we come to validity and clearing instructions. Validity instructions indicate when an order may be filled. So remember, execution is a how-to, validity is a when. So you can just think of this like VW. V validity, W when. So validity is when an order may be filled. And here are the different scenarios. You might have a day order which says execute today, good till cancel. So until I explicitly tell the broker to cancel, this order is good. Immediate or cancel, fill or kill. The name explains what this is. I'm telling the broker that either execute immediately, if you can't, then cancel. Good to close, or also called market on close. So these are good till the close of day. And then stop orders, these are also called stop loss orders. You can have a stop sell, which executes only after a trade occurs at or below stop price. So what these stop orders try to do is minimize losses. With a stop sell, you are telling the broker to stop losses by selling at a given price. Stop buy is execute a buy, and again the intent is to limit losses. The way you can think of this is, if you own a stock and you are worried about the stock crashing, then you might tell the broker that, look, the price is 50 today, but if the price starts dipping, then sell it at so and so price. Short buy or stop buy happens when you have a short position. So if you have a short position where the stock is currently at 20 and you took a short position because you thought the stock will go down, then you limit your loss by putting in a stop buy, because if the stock starts going up, then you will incur losses. Clearing instructions tell brokers and exchanges how to arrange final settlement of trades. When a trade is a long sale or a short sale, whether a trade is a long sale or a short sale is also a clearing instruction. Primary security markets. Primary markets are where issuers first sell their securities to investors. Issuers generally contract with an investment bank to help them sell their securities to the public. Investment bank lines up subscribers who will buy the security. This process is called book building. We could have an underwritten offering versus a best efforts offering. In an underwritten offering, the investment bank is buying the securities. So the investment bank is removing the risk from the issuer. In a best efforts offering, the investment bank is saying that, look, I'll try to find investors. I can't promise what price, but I will do my best to get the highest possible price for you. In an IPO, issuers sell securities to the public for the first time. The IPO could be oversubscribed or undersubscribed. An oversubscribed IPO, which is also called a hot IPO, which keeps coming up in ethics, is a scenario where the number of people or investors who want shares exceeds the number of shares. So in that case, the expectation is that the price will go up. So the demand is higher than the supply, so you will expect price to go up. In an undersubscribed scenario, the demand is less than the supply of shares. Note the fact that investment banks have a conflict of interest. Why? Because investment banks charge a fee, but the larger way of looking at this is, if the investment bank is buying from the issuer, let's say that this is an underwritten offering, what is the incentive of the investment bank? To buy at a price as low as possible, whereas what is the incentive of the issuer? To sell at a price as high as possible. So there is an inherent conflict of interest between the issuer and the investment bank. Seasoned or secondary offering, here the issuer sells additional units of a previously issued security. A company might have an IPO, which is the first time that it is issuing shares to the public. After that, if the company issues shares again, then that's called a seasoned or secondary offering. Private placement is where corporations sell securities directly to a small group of qualified or sophisticated investors, and in this case, they are relatively low disclosure requirements. With IPOs, when a company is selling to the public, the disclosure requirements are quite heavy. And the final point here, which is important, note that we are talking about primary markets where the issuer is actually raising money. Then in the secondary market, the shares trade between investors. So when one investor buys from another investor, the company, the issuer, doesn't get any money. But the company is very interested in what happens in the secondary market, because if we have a very liquid secondary market, that makes it easier for the company to raise money in the primary market. We'll now talk about secondary markets, and this material is quite testable because all the buying and selling of securities that you'll do will generally be in the secondary market. Trading in securities takes place in a variety of structures. We will consider three aspects of market structure. The first is trading sessions, second is execution mechanisms, and third is market information systems. So let's go to trading sessions first. Broadly speaking, we can either have call markets or continuous trading markets. And the most important points related to call markets and continuous trading markets are shown right here. In call markets, trades can be arranged only when the market is called at a particular time and place. Buyers, sellers find each other very easily. These markets are very liquid when the market is called, and completely illiquid when trading, and completely illiquid between trading sessions. Usually these are organized once per day. In continuous trading markets, trades can be arranged and executed anytime the market is open. Many continuous trading markets start their trading with a call market auction. So remember these points, they are quite testable. In terms of execution mechanisms, we can have order-driven markets, quote-driven markets, and brokered markets. So this is the information related to quote-driven markets. They are also called over-the-counter, price-driven, or dealer markets. Customers trade at prices quoted by dealers. So in essence, the dealers are providing liquidity. In brokered markets, brokers arrange trades among their clients, used for instruments where finding buyers and sellers is not easy. And order-driven markets, trading is based on rules. We have order matching rules, and these rules match buyers and sellers. So for example, if I'm a buyer and you are a seller, and let's say that there are actually multiple buyers, who will get preference? The one who's willing to buy at the highest price or lowest price? From a buyer perspective, the party willing to buy at the highest price gets precedence. So that might be one rule. Another rule might be if two parties are willing to buy for 50, then the party that put the order first gets precedence. So these are two very simple rules. You can imagine that these order-driven markets have more sophisticated rules, but the two that I just mentioned are most likely to show up on an exam question. Then the third aspect is market information systems. When we say that a market is pre-trade transparent, this means that the market publishes real-time data about stock prices and trade volumes and so on. Post-trade transparent means that data is published shortly after the trade. So after every trade, we know what stock was traded, what quantity, what price. But the key with post-trade is, as the name implies, the data is published after the trade. All right, filling a large order in a continuous trading market. Let's say at the start of the trading day, the limit order book for a certain stock looks like this. And then Tom submits to buy 150 shares, limit 34. What is the impact on the limit order book? So note that Tom is putting in an order to buy. So these are the offers over here. Sam and Simon are willing to sell at 33 and 34. So what is going to happen is Tom will buy from Sam and Simon. So these two will go off the map. So these two will get cancelled out. But then Tom will still be available to buy. So we'll still have Tom who is going to buy 50 at 34. So this is what the order board will look like after Tom's order.